This just flashed again, and it's the kind of signal that shows up before the crowd realizes the cycle has turned. The stock market can look strong, while the foundation quietly weakens. And in 60 seconds, you'll see why this matters for the USA economy and why silver keeps appearing in these moments. Here's the deal. This video is not about fear. It's about pattern recognition in modern finance. We're going to connect what's happening right now in DEC 2025 to one historical mirror, 2008, so you can understand what rhymes, what's different, and what to watch next without getting whiplash. Because the cycle doesn't announce itself. It whispers first. Reset hook. Most people watch prices. Smart people watch the pressure behind the prices. There are two worlds that live on top of each other. The liquidity world, how easy it is to borrow, refinance, roll debt, and keep the machine moving. The credit world, whether lenders actually want to take risk and at what price. When liquidity is abundant, mistakes get funded. Weak companies survive. Asset prices float. When liquidity tightens, the system stops forgiving errors. And here's what most people miss. The shift doesn't start with a dramatic crash. It starts with spreads widening, lending standards tightening, and small stress pockets that the headlines call contained. In late cycle moments, you'll often see strong-looking index performance, but narrower leadership underneath, and more quiet warnings from credit, banks, and funding markets. Some analysts argue the real trigger isn't the news. It's the moment rolling debt becomes more expensive than expected. That's not conspiracy, that's math. When rates stay higher longer, the refinancing calendar becomes a pressure cooker. And that's where commodities, especially monetary metals, start to matter. Not because they're magic, but because they often react to confidence in policy, currency stability, and real yields. Gold tends to get the spotlight, but silver can move like a risk-on metal until it suddenly doesn't. It's a hybrid. That's why it shows up in these turning points. Let's go back to 2008, but as a story, not a textbook. In the years before the crisis, the surface looked fine. Growth, confidence, financial innovation. But underneath, the system was building a fragile tower, leverage on top of leverage, and assumptions stacked on top of assumptions. At first, the cracks were small. It's just subprime. It's contained. Then the problem wasn't housing. The problem was funding. Who trusted whom, overnight, and at what cost? And when trust goes, everything reprices at once. Banks pull back, credit tightens businesses, freeze hiring. And investment consumers feel it later, and markets re-rate reality fast. Now, important difference. 2025 is not 2008. The plumbing has changed. The rules changed. The crisis playbook is better understood. Then the problem wasn't housing. The problem was funding. Who trusted whom, overnight, and at what cost? And when trust goes, everything reprices at once. Banks pull back. Credit tightens businesses, freeze hiring. Key and investment consumers feel it later, and markets re-rate reality fast. Now, important difference. 2025 is not 2008. The plumbing has changed. The rules changed. The crisis playbook is better understood. But the rhyme is this. Stress shows up first in credit and banking confidence, not in your favorite index chart. Reset hook. The lesson of 2008 isn't crash. It's ignore funding stress at your own risk. So how does this spread from a signal to a real economy move? Think of the system like a chain. 1. Rates and policy expectations. Central banks guide the price of money. Even if policy pauses, markets constantly reprice what comes next. That alone can tighten conditions. 2. Funding costs and refinancing. Companies, households, and governments don't pay a single interest rate. They pay the market's interest rate, plus a risk premium. When that premium rises, it's not theoretical. It hits cash flow. 3. Banks and credit creation. Banks don't just hold money. They create credit until they don't. When regulators get stricter, when losses rise, or when deposit competition intensifies, banks lend less. The economy feels it with a delay. 4. Jobs, housing, and consumption. Hiring slows quietly first. Hours get cut, and spending softens. Housing, which lives and dies by rates, often reacts early. And when housing slows, the ripple hits everything from construction to local budgets. 5. Markets reprice. The stock market doesn't crash because people suddenly got sad. It reprices because earnings expectations collide with tighter liquidity. And where do metals come in? In stress transitions, investors often recheck the store of value idea. Again, not a guarantee, but a recurring behavior. That's why silver and gold can start acting differently than pure industrial demand would suggest. Reset hook. The economy turns slowly until credit turns, and then it feels fast. Let's run 3 plausible scenarios: best, base, and worst, without drama. Scenario 1, best case. Controlled cool down. Trigger. Inflation cools without a major credit event, and funding stress stays localized. What it looks like: choppy markets, rotation under the surface, but no systemic shock. Translation: the USA economy bends, doesn't break. Scenario 2, base case: credit squeeze. Trigger: refinancing costs. Bite: banks tighten lending and defaults tick higher in weaker pockets. What it looks like: the stock market struggles with earnings downgrades, consumers slow, policy messaging turns more reactive. Translation: not a collapse, just a grind that surprises optimists. Scenario 3, worst case: funding confidence event. Trigger: something small hits confidence, an unexpected bank issue, a major credit market freeze, or a sudden dollar funding stress episode. What it looks like: fast repricing, forced selling, emergency liquidity measures. Translation: the cycle flips quickly. Reset hook: the question isn't, will something happen? It's, where would stress show up first? Here's your checklist: simple, trackable, and useful. Watch item 1, credit spreads. Are lenders demanding more compensation? Watch item 2, bank lending surveys, tightening standards. Is credit creation slowing? Watch item 3, funding market headlines, not politics, plumbing. Watch item 4, treasury volatility. Big swing signal stress in the risk-free benchmark. Watch item 5, the dollar's strength versus global stress. A strong dollar can tighten conditions globally. Watch item 6, unemployment trend direction, not the level, the turn. Watch item 7, housing activity, rates hit here early. Watch item 8, corporate guidance, are CEOs preparing for demand softness? Watch item 9, market breadth, are fewer names holding the index up? Watch item 10, gold, silver behavior. Are they acting like commodities or like a confidence barometer? If the system is dry, any spark spreads faster. Reset hook: if you track these 10 things, you'll see the turn coming before the headlines change tone. So here's the takeaway. In DES 2025, the message is not panic. The message is pay attention to the stress signal because the pattern is familiar. Liquidity tightens, credit reacts, then the real economy follows. The stock market doesn't warn you politely. It moves when the funding story changes. If you had to guess, what breaks first in the next phase? Credit, banks, or the consumer? Drop your answer in the comments and subscribe if you want more pattern-based breakdowns of the economy, finance, and what metals like silver might be signaling next.